Something extraordinary is happening in the silver market right now, and if you're not paying attention, you're about to miss one of the most explosive moves we've seen in decades. I'm talking about a coiling pattern that's been building for months, the kind of setup that doesn't come around often, the kind that, when it breaks, sends prices vertical in a matter of days or weeks. Let me show you exactly what's happening, why it matters, and what you need to do about it. Right now, silver is trading in the low 60s per ounce. Just recently, it touched an all-time high of $64.65. That's a 95% gain for the year. While gold has been making headlines with its own impressive run, silver has been quietly outperforming it by a massive margin. But here's what most people are missing. This isn't just a rally. This is the beginning of something much bigger. And the technical setup we're seeing right now suggests we're about to witness an acceleration that will catch even experienced traders off guard. Let me explain what a coiling pattern actually means. Imagine a spring being compressed tighter and tighter. The more you compress it, the more energy builds up. Eventually, when that spring releases, it explodes with tremendous force. That's exactly what's happening with silver right now. On the charts, silver has been consolidating in an increasingly tight range. The highs aren't getting much higher, and the lows aren't getting much lower. Volume is building. Volatility is compressing. Every technical indicator is pointing to the same thing. A massive breakout is imminent. And when I say massive, I'm not talking about a 5 or 10% move. I'm talking about the kind of move that could take silver to 80, 90, even $100 an ounce in a relatively short time frame. Now, you might be thinking, that sounds too good to be true. What's really driving this? Let me walk you through the fundamental picture, because when you understand what's happening beneath the surface, you'll realize this isn't speculation. This is mathematical inevitability. Silver is now in its 5th consecutive year of supply deficit. Think about that for a moment. 5 straight years where global demand has exceeded global supply. The total deficit over these 5 years has reached 820 million ounces. That's not a small number. That's a structural imbalance that cannot continue indefinitely. The Silver Institute recently confirmed that total silver demand in 2024 reached 1.16 billion ounces. Meanwhile, mine production has been declining. We're not finding new silver deposits at the rate we're consuming existing ones. And here's the kicker. Industrial demand alone accounts for 58% of all silver consumption. This is where silver becomes fundamentally different from gold. Gold is primarily a monetary metal and a store of value. Silver is both a monetary metal and an industrial commodity, and the industrial applications for silver are exploding. Photovoltaic solar panels require silver. Each panel uses about 20 grams of silver for its conductive properties. As the world transitions to renewable energy, solar installations are accelerating globally. Wind turbines use silver. Electric vehicles use significantly more silver than traditional combustion engine cars. The electrification of everything requires silver. 5G infrastructure requires silver. Data centers require silver. Medical devices require silver for its antimicrobial properties. The list goes on and on. And here's the critical point. This industrial demand is not price-sensitive in the way investment demand is. A solar panel manufacturer doesn't stop buying silver because the price went up 10%. They need it for production. They have no choice but to pay the market price. So you have this situation where industrial users are competing with investors for a shrinking pool of available silver. And increasingly, investors are waking up to the opportunity. Let me tell you about what's happening with institutional money right now. Central banks have been accumulating gold at record levels. Everyone knows that story. But what's flying under the radar is how smart money is positioning in silver. The gold-to-silver ratio tells us something fascinating. Historically, this ratio has averaged around 69 to 1. That means it takes 69 ounces of silver to buy 1 ounce of gold. Right now, even after silver's massive rally this year, the ratio is still around 79 to 1. Silver remains undervalued relative to gold by historical standards. But here's where it gets interesting. When you look at periods of monetary stress, financial crisis, or major bull markets in precious metals, the gold-to-silver ratio compresses dramatically. In 1980, At the peak of the Hunt brothers' silver squeeze, the ratio briefly touched 15 to 1. In 2011, during the last major precious metals bull market, it dropped to 32 to 1. If we simply return to the historical average of 69 to 1 and gold stays where it is, silver would need to rise significantly. If the ratio compressed to 50 to 1, which is entirely possible in a major bull market, you're looking at silver well over $100 an ounce. Now, I want to take you back in time for a moment because understanding history is crucial to understanding where we're headed. Let me tell you the story of what happened in 1971. On August 15, 1971, President Nixon closed the gold window. For the first time in history, the U.S. dollar was completely untethered from gold. No longer could foreign governments exchange their dollars for gold at a fixed rate. The dollar became a pure fiat currency, backed by nothing but faith in the U.S. government. What happened next was predictable. Gold, which had been fixed at $35 an ounce, began to rise. By 1974, it had reached $180, but that was just the beginning. By January 1980, gold peaked at $850 an ounce, a 24 times increase in less than a decade. But here's what most people forget. Silver did even better. In 1971, silver was trading around $1.50 per ounce. By January 1980, it reached $50, a 33 times increase. Silver outperformed gold by a significant margin during that bull market. Why? Because silver has this dual nature. It's both a monetary metal and an industrial commodity. When inflation surges and currency debasement accelerates, investors flee to precious metals. But simultaneously, industrial demand continues regardless of the economic environment. This creates a perfect storm for silver prices. Now fast forward to 2008. The global financial crisis hits. Lehman Brothers collapses. The Federal Reserve begins quantitative easing, essentially printing trillions of dollars to stabilize the financial system. What happened to silver? In November 2008, silver bottomed at $8.88 per ounce. By April 2011, just 2.5 years later, silver peaked at $48.70, a 5.5 times increase in a very short period. And here's what's crucial to understand. We're now in a situation that combines elements of both 1971 and 2008, but potentially much more severe. Since 2008, central banks around the world have printed more money than in all of human history combined. The U.S. national debt has exploded from $10 trillion to over $35 trillion. The Federal Reserve's balance sheet has expanded from under $1 trillion to over $8 trillion at its peak. The European Central Bank, the Bank of Japan, the Bank of England, all engaged in massive monetary expansion. And it's not stopping. Despite talk of tightening, despite interest rate increases, the fundamental trajectory is clear. Governments are addicted to deficit spending. Central banks are trapped. They cannot allow interest rates to rise too high without triggering a debt crisis. They cannot stop printing without causing a deflationary collapse. This is the environment in which silver is coiling. This is the backdrop against which this technical pattern is forming. And this is why the breakout, when it comes, is likely to be far more explosive than most people anticipate. Let me talk about the COMEX for a moment, because understanding the paper silver market is essential to understanding what's about to happen. The COMEX is where silver futures are traded. It's where the price of silver is largely determined. But here's the dirty secret. The vast majority of silver traded on the COMEX is paper silver. Contracts that represent silver, but where physical delivery almost never occurs. The ratio of paper silver to physical silver is estimated to be somewhere between 100 to 1 and 250 to 1. That means for every ounce of physical silver that actually exists in COMEX warehouses, there are 100 to 250 ounces of paper claims on that silver. This works fine as long as everyone plays along, as long as traders are content to settle in cash rather than demanding physical delivery. But what happens when that changes? What happens when a large player or multiple players start standing for delivery? What happens when the paper market is forced to deliver physical metal it doesn't have? We've seen glimpses of this stress already. In March 2020, during the COVID panic, the silver market experienced severe dislocations. The spread between paper prices and physical prices blew out to unprecedented levels. You could buy silver futures for $17 an ounce, but try to buy physical silver coins or bars, and you were paying $25 to $30 if you could find any at all. The system came very close to breaking. Mints around the world ran out of inventory, premiums exploded, delivery times stretched to months, and that was just a taste of what could happen in a real supply squeeze. Right now, COMEX silver inventories are declining. Registered silver, the category available for delivery, has been dropping steadily. At the same time, open interest in silver futures remains elevated. The ratio of open interest to available physical silver is at concerning levels. If we see a rush to physical delivery, if industrial users start getting nervous about securing supply, if investors decide they want metal in hand rather than paper promises, the COMEX could face a crisis. And when that happens, prices don't go up gradually. They gap. They spike. They go vertical as the paper market scrambles to source physical metal at any price. Now, let me shift gears for a moment and talk about something that's relevant if you're thinking about your long-term financial security. If you're sitting on $100,000 or more in retirement accounts, there's something you should know about gold IRAs. I put together a free guide that explains how they work, how you can get physical precious metals into your retirement account without triggering tax penalties, and what the process actually looks like. It's in the description below. Worth checking out if that's relevant to your situation. All right, back to what's happening in the silver market right now. Because there's another dimension to this story that we need to discuss: the geopolitical angle. We're witnessing a fundamental shift in the global monetary system. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, are actively working to reduce their dependence on the US dollar. They're settling trade in local currencies. They're building alternative payment systems. And they're accumulating gold and silver as reserve assets. China has been particularly aggressive. Chinese silver imports have surged in recent years. The Shanghai Gold Exchange, which also trades silver, has seen explosive growth in volume. Chinese investors, both institutional and retail, are buying physical precious metals at unprecedented rates. Russia, facing Western sanctions, has been forced to find alternatives to dollar-based trade. They're settling energy exports in rubles, yuan, and increasingly, with gold and silver as backing. Iran, also under sanctions, has been accumulating precious metals. Saudi Arabia is diversifying away from pure dollar reserves. This isn't conspiracy theory. This is documented policy from these nations. They've stated explicitly that they want to reduce dollar dominance. And the way you do that is by building reserves of real assets, assets that cannot be printed, assets that have intrinsic value. Silver plays a unique role in this shift because it's more accessible than gold. A nation can accumulate significant silver reserves without moving the market as dramatically as large gold purchases would. Silver is also more useful for smaller transactions and trade settlements. And as I mentioned earlier, silver has industrial applications that make it strategically important beyond just monetary value. So you have this convergence of factors: structural supply deficits, exploding industrial demand, monetary debasement, geopolitical shifts, and a technical setup that suggests imminent breakout. Each of these factors alone would be bullish for silver. Together, they create a situation that's almost unprecedented. Let me paint a picture of what the next 12 to 18 months could look like. Silver breaks out of this coiling pattern. It takes out the all-time high at 64.65 convincingly. Momentum traders pile in. The move accelerates. $70, $80. Media starts covering it. Retail investors who missed the gold rally see silver as the more affordable option and start buying. Industrial users, seeing prices rise and worried about supply, start forward buying to lock in inventory. This removes even more physical silver from the market. COMEX inventories drop further. Premiums on physical silver expand. The paper market comes under stress. At some point, maybe at $90, maybe at $100, maybe higher, something breaks. A major player stands for delivery, and the COMEX can't deliver. Or a large industrial user announces they're having trouble sourcing silver, or a government announces a strategic silver reserve program. Whatever the catalyst, the market goes into panic mode. Prices gap higher. Trading halts become frequent. The spread between paper and physical blows out again, but this time much worse than in 2020. Silver becomes hard to find at any price. And suddenly, everyone who was skeptical, everyone who thought precious metals were a relic of the past, is trying to buy. This is not a prediction. This is a scenario based on the fundamentals and the technical setup we're seeing. Could it play out differently? Of course. Markets are unpredictable in their exact timing and path, but the direction seems increasingly clear. And here's what you need to understand. By the time this becomes obvious to everyone, by the time mainstream media is covering it, by the time your neighbor is talking about buying silver, the easy money will have been made. The big gains come from positioning before the breakout, not after. Look at what happened with gold recently. Gold spent years consolidating, building a base, while skeptics said it was dead. Then it broke out. It went from 1,800 to over 2,700 in a relatively short period. The people who made the most money were the ones who bought when gold was boring, when nobody was talking about it, when it was consolidating. Silver is at that point right now. Yes, it's had a big run this year, but relative to where it's going, relative to the fundamentals, relative to the technical setup, we're still early. The coiling pattern suggests the real move hasn't even started yet. Let me address some common objections I hear. First, people say silver is too volatile. It's true, silver is more volatile than gold. But volatility cuts both ways. Yes, silver can drop sharply, but it can also rise sharply. And in a bull market, that volatility is your friend, not your enemy. The same volatility that scares people away is what creates the opportunity for massive gains. Second, people say industrial demand could drop in a recession. This is partially true. If we have a severe global recession, industrial demand for silver would decline. But here's the counter-argument. In a recession, central banks print even more money. Monetary demand for silver increases. And historically, silver has performed well during both inflationary periods and during financial crises. The monetary aspect tends to overwhelm the industrial aspect during times of stress. Third, people say governments could confiscate precious metals like they did in 1933 with gold. This is theoretically possible, but highly unlikely with silver. Silver is too widely distributed, too industrially important, and too difficult to track compared to gold. The logistics of a silver confiscation would be nearly impossible, and even if it were attempted, it would likely drive prices even higher as people refuse to comply. Fourth, people say you can't eat silver, it doesn't produce cash flow, it's not a productive asset. All true. Silver is not a business. It's not real estate. It's not a dividend-paying stock. But that's not the point. Silver is insurance. It's a store of value. It's a hedge against currency debasement and financial system instability. You don't buy silver to generate income. You buy silver to preserve wealth and to profit from monetary chaos. Now, let me talk about the practical aspects of positioning for this move. There are several ways to gain exposure to silver. You can buy physical silver coins or bars. You can buy silver ETFs. You can buy silver mining stocks. You can trade silver futures or options. Each approach has advantages and disadvantages. Physical silver gives you direct ownership, no counterparty risk, no dependence on the financial system, but it requires storage, insurance, and has higher transaction costs. Premiums on physical silver can be significant, especially during periods of high demand. Silver ETFs provide liquidity and ease of trading, but you don't own the physical metal. You own shares in a fund that claims to hold silver. There's counterparty risk. And during a real crisis, there's no guarantee you could convert those shares to physical metal. Silver mining stocks offer leverage to the silver price. When silver rises, mining companies' profits can rise even faster, driving stock prices higher. But mining stocks come with company-specific risks: management quality, operational issues, political risk in the countries where they operate. And mining stocks are still stocks, subject to broader equity market volatility. Futures and options provide the most leverage but also the most risk. You can control large amounts of silver with relatively small capital, but you can also lose everything if the market moves against you. These are tools for experienced traders, not for most investors. My view is that a diversified approach makes sense for most people. Some physical silver for insurance and peace of mind. Some exposure through ETFs for liquidity. Maybe some mining stocks for leverage if you're comfortable with the additional risk. The exact allocation depends on your situation, risk tolerance, and investment goals. But the key point is this. If you believe the fundamental case for silver, if you understand the technical setup, if you see the coiling pattern that's forming, then you need to be positioned before the breakout occurs. Because once it happens, once silver starts moving, the opportunity to buy at these levels will be gone. Think about where we are in the bigger picture. We're living through the end of a monetary era. The post-World War II dollar-based system is breaking down. Debt levels are unsustainable. Central banks are trapped. Geopolitical tensions are rising. The world is fragmenting into competing blocks. In this environment, hard assets matter. Real things matter. Silver is one of the most undervalued hard assets on the planet right now. It's been overlooked, dismissed, forgotten by mainstream investors. But that's changing. The smart money is accumulating. The technical pattern is forming. The fundamentals are aligning. And when this coil snaps, when silver breaks out of this consolidation pattern, the move is going to shock people. We're not talking about a gradual rise. We're talking about the kind of explosive move that creates life-changing wealth for those positioned correctly. I've been watching precious metals markets for years. I've seen bull markets and bear markets. I've seen false breakouts and real breakouts. And I'm telling you, what I'm seeing in silver right now is as compelling a setup as I've ever witnessed. The combination of fundamentals, technicals, and market positioning is extraordinary. The supply deficit is real. The industrial demand is real. The monetary debasement is real. The geopolitical shift is real. The technical coiling pattern is real. This isn't speculation or hope. This is analysis based on facts and data. Now, I can't tell you exactly when the breakout will occur. It could be next week. It could be next month. It could be 3 months from now. Markets don't operate on our schedule. But what I can tell you is that the longer this coil compresses, the more energy builds up, the more explosive the eventual move will be. And here's the thing about breakouts. They happen fast. You don't get a warning. You don't get time to think about it. One day you wake up and silver is up 5%, then 10%, then 15%. And suddenly you're chasing, buying at higher prices, wishing you had positioned earlier. The time to act is when things are quiet, when nobody's talking about it, when the setup is forming but hasn't triggered yet. That's when you get the best prices. That's when you can position calmly, rationally, without emotion. Right now, silver is giving you that opportunity. It's coiling, it's building energy, it's setting up for a massive move, but it hasn't broken out yet. You still have time, but that window is closing. Think about what you want your financial situation to look like 12 months from now. Do you want to be the person who saw this coming and positioned accordingly? Or do you want to be the person who watched it happen and wished they had acted? The choice is yours. The information is in front of you. The setup is clear. Silver is coiling tight. And when it snaps, when this pattern breaks, the move is going to be huge. Get ready.